The consumer is stressed and it gets worse every single month. There's data that's coming out showing that this is impacting the real estate market, specifically residential sales, where we're just grinding along the bottom and the lowest number of sales for a very long time, even worse than the great financial crisis. Let's dig in why this is happening, what's happening with the consumer, and what this could mean going into the end of the year in our prediction on how much home prices will fall from now until the end of the year. So this is the crazy part about it is that consumers simply just don't have money. The middle class is getting eroded away very quickly and they're maxed out with tons of debt. So you might see charts showing that, 40% of properties are completely paid off. Yes, that is owned by this top 10%. The bottom 90% are absolutely struggling in this economy. If they don't own stocks, they don't own assets, and they're just getting into the market right now, they have been completely left behind. So this is from Reventure. It's income and home price growth from 2019 to 2024. So look at this. Median household income, a 5-year change went from 68,000 to 83,000. Now, this looks great on the surface, a 21.9% increase in income. Phenomenal, right? But look at what the monthly mortgage payment, and we live in a payment economy, right? Mostly everyone finances everything. If you think about your car, you think about your house, you think about other assets that you buy, your credit cards, everything like that that you use. But your monthly mortgage payment jumped from $1,400 to $2,800 per month. And that's nearly 100% increase in the mortgage payment just within a 5-year period. So if you are a young buyer looking to purchase in today's market, it is so much more expensive relative to your income to be able to purchase a home. Now, this is holding back the entire real estate market. We hope that prices come down so that the next generation can get into buying their real estate. Will it all depend on what the government decides to do from here and if they're going to prop up and bail out basically boomers or people who own a bunch of real estate, or if they're going to let the prices actually adjust down to a market rate and let the economy be a real economy that's unmanipulated. We don't think that's going to happen. We think the government will continue to push and pull on the housing market, but the reality is I'm not sure there's much they can do at this point to avoid this type of spread. When you're looking at those numbers over there, I mean, that's insane. That's absolute insanity. So either household income has to come up or prices have to come down. I don't think manipulating interest rates is going to be enough. Now, this home price to median household income ratio is worse than the great financial crisis. So I see a lot of people out there saying, oh, it's not worse than the great financial crisis. Well, it depends on what data you're looking at. If you're looking at number of sales, yes, we're getting near that point. We're actually worse than the great financial crisis. If you're looking at inventory for new homes in the South, yes, we're worse than the great financial crisis. But the worst part of everything is the affordability crisis right now is worse than what happened since the great financial crisis. So when we are looking at this chart, it is just terrifying. It looks like we had a little bit of a pullback because rates came down and then, rates moved back up. Recently, we saw rates move down a little bit, but now again, they're starting to move back up. So it's been very volatile as the government continues to put political pressure on the Fed to move short-term overnight borrowing rates down. But that does not necessarily influence or impact the long-term rates. Actually, it could cause long-term rates to move up because of fears of inflation, which is what we've seen in the last 24 hours. So cheaper to rent than to buy. So this is the other thing. You need to take this into account. Yes, there are full communities that are being sold to hedge funds for build to rent. Sure. But those build to rent communities still have to rent out those units, and that rental supply is coming on, and it's driving rents lower in the South. So look at this. This is rental affordability is superior to mortgage affordability. This comes from Goldman Sachs. So it is much cheaper right now to rent a property than to buy a property. So buyers have options. They can either double up in a property, they can move locations to go somewhere that's more affordable, or they can just decide to rent and not have to buy. So if they're not buying, then you're going to have these houses sitting on the market. And, I don't think people are stupid. The data is out there and people understand I can rent this same exact house that I could buy for $700, $800, $900 less per month and not have to deal also with the maintenance and the insurance and the taxes and all that type of stuff associated with it. So it is now less affordable to buy than it is to rent in most circumstances. And this is causing housing demand to just plummet, right? So everything is about affordability. Affordability drives home sales. We see affordability crisis peak up. that drives home sales down. And now we could be grinding along the bottom here at a rate. This is for existing home sales annualized, record low home buyer demand to start 2025. I mean, we could be grinding along the bottom here at the great financial crisis levels for some time here until the affordability returns back to the market. So demand is really slowing. This is a great chart from Darth Powell. If you see him on X, I'd highly recommend you follow him. He says a bunch of things on there, but I like his charts and the data that he shares and the perspective he shares. But look at this. On this side, the mortgage payment percentage of income. This is the percentage of income. That's insane. So it was really low right after the great financial crisis, but now we're talking about 40% of somebody's income is going towards their mortgage payment. That is insane. There's no way to save money if you're a younger generation and you're buying now, if 40% of your income is going to your mortgage payment. So affordability ultimately determines sales volume. You can see that on the chart. The orange lines are the number of sales. So, obviously if affordability as a percentage of payment to income skyrockets, then the number of sales drops. And that's a chart that I think is a really interesting one to look at. And I hope you spend time looking at this one because I think it tells the entire story of housing, right? And if we've had dropping interest rates literally for 40 years, obviously that's going to push prices higher because they are more affordable from a payment perspective. The inverse will happen right when interest rates start moving up. So the existing owners are doing okay, right? If you bought back in, the 2013 to 2020 time period, you still have a lower rate. Now, if you bought more recently, obviously your payment's going to be higher. But if you're buying with a mortgage right now, so this is monthly mortgage payment to buy versus the existing outstanding mortgages. Look at that. I mean, the gap is huge. And so this is creating a lock-in effect. So the people who have their existing owner mortgage cost, why would you sell to go buy another house? It just wouldn't make sense. You would be increasing your payment basically nearly $1,000. So it's creating a lock-in of these older generations and people who already own homes to not sell because they want to hold on to their low monthly payment. And that's a problem because 70% of people who sell go to buy. So it's pushing all these transactions that would naturally happen are no longer happening now because of this lock-in effect. And this is causing new homes to just skyrocket. The number of new homes for sale is greater than August 2006. We're past the peak of the great financial crisis of these for sales. This is, South region. You can see the states that this is including. But this is despite the incentives, right? These builders are saying, hey, we'll buy down your interest rate. We'll give you upgrades to the house. We'll give you all this. And still the number of new homes for sale are skyrocketing. I know here locally in Jacksonville, these communities that started in 23, 24, it's taking 2 to 3 years to build out. They are still being built out to this day. And we're going to have tons of inventory coming over the next year or two that's going to continue to stack up these new homes for sale. And we think that's going to continue to drive prices down. This comes from the U.S. Census Bureau and a couple other sources. Now, Florida home prices, obviously, when you see so much inventory go up, especially on new construction, which is what the next generation actually wants because they don't want to have to put a bunch of money into a house. They want everything to look great. They don't have the cash to be able to make the repairs. That's going to drive down new construction. That's going to drive down the price of existing homes. But Florida prices are coming down. This is from the Zillow home index, and comes from Macro Edge chart, but you could see that things are starting to reverse. We were positive, positive, positive. We saw this massive spike because of the Federal Reserve's intervention, and now we're going negative, and it's likely that we'll continue that negative decline into the coming months of next year, which has put us squarely into a full-fledged buyer market in Florida. So this is the 7 major cities that are now buyers markets. So you can see here that 4 of those 7 are in Florida. One of those is Jacksonville. That's where I'm at. You see Miami, Austin, Texas. Austin is getting absolutely crushed. My friends there who flip houses and sell houses are just saying, prices are coming down. There's not as many relocations here. They continue to build. There's a lot of area to build, just like Florida. Relocation slowed down. There's a lot of area to build. The builders overbuilt. They thought that the people from the north and from the west would continue migrating at the pace that they did between 2020 and 2022. It's just not the case. And it's a speculative bubble. And now that bubble is starting to have the air let out of it. And I'll let you know what my recommendation is by the end of this video. If you want to drop a comment, let me see, if you're in Austin or any of these markets, please comment because we'd love to see what's happening with your month's supply of inventory. Are you seeing basically hope for sale signs all across your neighborhoods. I can tell you here, I'm seeing them in my own neighborhood. I'm seeing everywhere I drive. There's like two houses for sale on every street, and then there's new construction still being built on every corner, which is crazy. So it shows here Jacksonville, Florida, 6.3 month supply, which typically is a balanced market. But the reality is these markets swing like a pendulum. It's either a buyer's market or it's a seller's market. And right now we're switching from a seller's market to a buyer's market, and it accelerates here at the bottom. And we're going to swing right into a full-fledged buyer's market by the end of this year. And what is the Fed doing, right? They're going to try to print money because things are only going to get worse. And they're anticipating now that things are going to get worse in the labor market. And they did a 25 basis point rate cut, and they expect to have two more by the end of the year. Obviously, Trump is trying to pressure Powell and others on Fed chair, other people on the Fed, to reduce rates even more than what they're currently projecting, so that way it can drive the economy. But again, it's dual mandate of inflation and employment, and inflation is still a problem, and it's likely to show up big in the numbers in the next couple months. So I don't think it's going to get any better anytime soon. So I don't know what the Fed's going to do, but I can't imagine that they're going to significantly cut rates the way that Trump is wanting to happen. And look, like owners are already starting to hurt, even though things are pretty normal right now. They're just getting crushed. Owners are hurting. Like, this is a search from Google for help with mortgage from 2004 to now, and it looks like it's just jumping up. People are actually they're starting to go underwater. People who purchased from 21 to 25, like now, they're now underwater in their house in a lot of areas. Not every area, but definitely here in the South. In specific areas, there's just pockets where there's tons of new construction that you're competing with. The relocations have stopped, and the inventory just continues to stack up, and that's causing multiple problems. So I can see why people are having problems with their mortgage. And frankly, all the costs of maintaining a house have just gone up as well, right? Fixing your house, those costs have gone up 50% within 5 years. Insurance is up 72%. And their property taxes have basically doubled. So I get why these homeowners are hurting, but not only are homeowners hurting, but renters are hurting. This is a chart that came out from Shandon Economics that late payments on rents are up 2%. This is mind-boggling. 2% might not seem like that much, but it's up about 1.5 million units that are now late on their payments in July, which is just mind-boggling. And so this could be a bigger risk. If people aren't paying their mortgage, they're not paying their rent. I mean, those are the last thing that you stop paying. You usually stop paying your credit card bills. You stop paying. This just goes to your car loans. This just goes to how stressed the consumer is by the amount of inflation that has been caused by our Congress and our Federal Reserve continue to print and borrow money that makes the value of the dollar much less, and pushing these everything more expensive. So I don't think the tariffs are going to help. Again, I think that's going to show up later this year in the inflation numbers and could pause the Fed from moving forward with more rate cuts. Now the red flags are up, right? Even Sherwin Williams suspends 401k matching amid weak sales. Like, businesses are struggling. Anything around the real estate market is starting to struggle, including, this is a paint supply company. This is insane to me that this stuff is already happening, because we're just at the beginning of this. So if they're already struggling, that's a big red flag. And, of course, owners are plagued by insurance, repairs, and taxes. This shows the average annual projected home insurance costs by state. You can see Florida is one of the worst. Obviously, we have hurricane issues, but it is crazy the amount of insurance that we pay. Even on my house, I pay like $15,000 for more than $1,000 a month. And of course, whenever you make a claim or anything, it's like impossible, and the deductible's high. It's like, it's kind of crazy. And I live over here right under Georgia. So we don't usually even get hit by hurricanes, but just because we're in the area, we're in the state, we are responsible for paying for basically everybody else's issues that they have. Now, one of the interesting things is that there's surveys that are coming out, right? So there's this divide between boomers and younger generations, and there's a little bit of strife. Boomers say, the younger generation needs to work harder. They just need to save more. They need to double up, just like I did. But the problem is it's actually 4 times from an income to shelter cost. It's 4 times more expensive than a lot of these boomers when they were purchasing. So it's like, how are you going to save when 40% of your income is going straight to shelter costs, and you have everything else that's 4 times more expensive than you had when you were growing up? So I understand both perspectives. Yes, there are a lot of lazy younger generation people. There's no question, and they're terrible with money, and they don't they don't manage it well. I think that's true with almost every single generation, but also it is legitimately 4 times harder for these younger generations to get by. So this was a survey that came out. Almost three-quarters of boomers, 73%, say that they value stability in their community over affordability for younger generations to move in. This makes sense, right? The majority of boomers, their net worths are tied up in their houses. They cannot let housing prices fall because they would then not have, really good option for the future to sell and take care of themselves in their golden years. Meanwhile, not 59% of boomer homeowners would vote for a political candidate that prioritizes protecting home values, even if it meant fewer people could afford homes. This is just self-interest, of course, right? This is not surprising that homeowners would try to pick candidates that could prop up housing prices. But this is a divide that I think is going to be really important because the government will have to decide whether they're going to bail out boomers who are in charge of the government generally, or they're going at the expense of the younger generations, or if they're just going to let the market be free and let the younger generations actually have an opportunity to purchase, because they have to move they have to move the cheese from one or the other, because both will not be winners in this type of environment, unfortunately. But it does show an interesting divide between the wealth that we're seeing. And frankly, the next generation, I don't know what's going to happen in the next 20, 30 years because it is not looking good from a demographic standpoint. Gen Z leads the biggest drop in FICO scores since financial crisis. This is already happening. And again, the stock market's at record highs, Bitcoin's at record highs, but the consumer is stressed. So, and by the way, like this next generation, my generation too, we don't have pensions. We will probably not see Social Security. And many people are loaded up with massive loads of student debt that they feel like they can't get out of. So I'm not sure how this next generation, if they can't buy a house, which is an automatic wealth builder, right? It acts like a piggy bank. I'm not sure how we're going to be able to get out of this. And I think, a lot of people say, well, they're going to get inheritances from the boomers sadly passing away. I'm not sure that that's going to happen because a lot of that wealth will be gone to hospitals, long-term care facilities, and things like that. I think that's going to drain the boomers before they leave because people can extend their life by an extra 10 years in some cases if they have really good health care. So I'm not sure that would actually transfer down to the next generation. And by the way, if it's a house that transfers to the next generation, 70% of this time the estate will then sell that house because they don't want it, right? They don't want the old carpets. They don't want to have to do all the repairs. It's not where they live. It's not the type of house that they want, all those type of things. So that's just going to go right back in and then get split up amongst multiple people. That's probably not going to be enough to make a significant change. But look at this is crazy. This is FHA. The next subprime crisis is FHA, that you can only have like a 580 credit score to be able to get an FHA loan. You only have to put 3.5% down, so you don't have a lot of skin in the game. So if you buy it the wrong time and the market goes down, your chances of handing the keys back to the bank are really high. Now, this shows that roughly 200 billion already of FHA mortgage loans are currently delinquent. I've seen stats that go up to 15.3%. The government stopped reporting a lot of this data back in February. They just removed it from their website, which was really scary. But look at that. I mean, that is just crazy, the number of active loans for FHA. So you're probably going to see going into next year a lot of foreclosures that are being processed through FHA or another government programming that comes out to prop up FHA and keep the housing market propped up. But there are underlying issues that are coming up across the real estate world that you might not have heard of. Now, this is also kind of terrifying, from if I'm looking at like a healthy economy. The problem is the majority, or not the majority, but a lot of the spending from consumer is coming from the top 10% of households. It's not coming from the middle class. The middle class is just getting eroded away. And those are the ones who would be purchasing the house, right? If you're wealthy, you don't need multiple houses. You usually get one house or a vacation home. Now you can, Airbnb and things like that. But the middle class is loaded up with debt. They're not spending. They don't have the cash to spend. And what is driving the economy right now are generally these wealthiest top 10 to top 20% of households, and the bottom 80% are frankly getting left behind. You can actually see this in the housing market as well by the age distribution of home buyers and home sellers by generation. You can actually see that the younger boomers are currently driving the buyers, and then it's Gen X after that, and then older millennials. So you can see that and the older boomers too are purchasing more than the older millennials. So this is really crazy as a stat. And then so it's basically boomers trading houses to other boomers. I don't know if this is good or not, but it doesn't look like a healthy economy to me. What I would like to see is tons of people in these younger generations to be, younger millennials to be able to purchase, people in their 30s, young 30s, late 20s being able to purchase homes. They are doing it, but they're a very small percentage. I mean, look at that 12% of 15% if you add in Gen Z. This does not look like a healthy economy to me from a purchasing standpoint and a selling standpoint. And this chart is the scariest chart of all. Young boomers are driving what remains of the market. So you can see repeat buyers, 61 years old, the median home buyer age. That all buyers is 56 years old. That's kind of crazy to me. And the first time home buyer has basically moved up 9 years from 29 years old to 38 years old. That's just because people are loaded up with debt they can't afford. They usually need to get a gift from family, or it's a dual income family that's been, saving their nickels together to be able to get a down payment to purchase. This is not good. I think this is just what's happening just due to this affordability crisis because the government has just pushed prices up so much. And frankly, if you're in the bottom of 50% in the United States, you are falling behind from a wealth standpoint, and the majority of gains are going to, the top percent. Look at this, the top 10% is has the biggest amount of gains over the last, couple decades here. And the bottom 50% of households only own 2.5% of US wealth. I think that this is going to continue to, happen. Most of the gains will go to the top who own assets, and then the bottom will continue to lose, market share basically. Yeah, I don't see how it can get much worse than this, but it does typically seem like it's going in that direction based on what the government is doing with their massive amount of printing and propping asset values up. So I think a lot of people are getting left behind. And of course, now we're seeing job weakness. We can see every modern recession has been preceded by rising unemployment. We're seeing rising unemployment here. You can see that on the red line. It's very slight, but it is moving up. But the big red flag is that the job openings are slowing down, probably because of AI, probably because there was a lot of businesses that were expanding and the tariff concerns, all this stuff people are starting to pull, or people are trying to replace people with technology, or make, frankly, give me a comment below. People, I know my brothers are like this, but they give them the job of like four people to one person. And they're just like, you got to figure out how to do your job and we'll pay you a little bit more to be able to do that. The layoffs are rising. You can see Florida is one of the top states for layoffs. And the consumer has so much debt, right? We've never been this much in debt. I mean, it is crazy and it continues to compound. And I think that we'll continue to see our debts go exponential, not just with consumers, but with the government. Credit card delinquencies are ticking higher. We're almost already as bad as we were during the great financial crisis. And the consumer sentiment is at the worst since the great financial crisis type levels. So we are already there. It's going to get worse. And my prediction for housing, because of these issues, in Florida specifically, and in Jacksonville, where I am, my expectation from the peak, which was in October of 2022, to the bottom, we should see at a minimum a 31 to 42% decrease in home prices based on my financial models from my prior investment banking experience and my experience of being in real estate for the last decade, transacting more than $3 billion of real estate. That is my expectation based on how I run the numbers, because at a certain point, there will be buyers that will come back in to the market once the price gets to an equilibrium, gets competitive with renting, and the builders stop building because it doesn't make sense to do so, and the buyers catch up with that. But during that time period, which can play out over multiple years, real estate is an illiquid asset class. It can take 4 to 5 years for this price discovery to actually occur and get back to reality. So, this isn't going to happen overnight by any means. This is going to be slow declines every single month for a matter of years until it gets to an equilibrium. So I'd love to hear from you. Consumers keep this market going. I think it's unlikely. I think they're tapped out. I'd love to hear your thoughts though. How much do prices need to come down for you to be able to purchase in your areas? Let us know. Like and comment the videos. Always appreciate you guys supporting the channel. I just got this started about a little bit over 90 days ago, and click the subscribe button. I come out with 2 videos per week. If you guys really like my stuff, I'll come out with 3 eventually, but appreciate you following and getting the update scoop of what's happening on the ground in real estate backed by data. And as always, if you want to follow my Substack, the information is below. And, go ahead and subscribe. I talk about things there that I can't talk about on YouTube, and you'll get an update every time a video comes out. Thanks so much for following. See you later.